In this video, I'm going to discuss with you the two most important agendas on a bank's list when they take trades. So first we have a discount, and then we have a premium. So there's no order to it. It's discount or premium or discount. So we have a discount and we have a premium. Now, when price is trading at whatever level it is trading at currently, whether it's a buy or a sell, and the market is moving in a upwards direction, as per this example. Now, it can be a bearish or a bullish scenario. The idea I want to get across to you is that banks will never buy at current market price. They do not do that. Retail traders buy at current market price. So in actual fact, what will happen is, instead of buying where the market is currently trading at this level over here, they will sell first and then buy upwards. So this is what we call a discount, where they buy something, like if you think of it when you buy a car and you negotiate with the dealer to get a discount. You want a discount to buy the car at a better price. So the same can be said here. The bank will not buy at current market price. They will sell and then buy. And that is what we call a discount array. It's called a discount array. And the same can be said for premium, but obviously in reverse. So we have a downwards move here, and it goes, as you know, up, down, and they will sell at a premium because they want to sell at a higher price. They will not sell at current market price over here. They will first buy to sell, and then they will sell down. And this is called premium, the premium array. So the idea is that when they are buying, or the market is bullish, you can expect to buy at a discount price. And when the market is bearish and going down here, you can expect for price to buy first and then sell. So to summarize, they will always sell to buy and buy to sell. So they want to sell at a premium and they want to buy at a discount. Okay, so how do we go about establishing whether or not they want to buy or sell at a discount? Well, it's quite simple, really. Just like all the previous concepts I have shown you, there is something we use on MetaTrader, whether it be on your phone or on your PC. This is what we call the Fibonacci retracement tool. Now, this is not just any Fibonacci retracement tool. It is not the default settings that you get off the internet or YouTube. You won't find these settings anywhere else besides people who use these concepts. So this particular Fibs settings are different to other settings, and we can see here that these are the fib settings. So I will just leave this on the screen for a few seconds, and you will see that these are the fib settings needed to establish whether we want to buy at a discount or sell at a premium. So you just apply these settings to your fibs. Now, to do that, you just take your fibs and you double click on it, say fib properties with a right click. And when these come, you just go ahead and delete all of the ones that are already in here, and you place them inside the ones that I've just given you on this document. So to continue here, when we are seeing price going up here, so here price is going up, and instead of buying at current market price, the bank will first sell to buy. So essentially what we do, we forget what you know about using fibs. We use the bodies of the candles. So if we take from body to body here, we want to buy at a discount. So when price goes up and then comes back down, we want to buy at a discount. So our discount price levels are the 62% retracement, the 70.5 retracement, which is also called OTE, which means optimal trade entry. And then we also have the 79% retracement. And basically, this whole area here between the 62, the OTE, and the 79 is what we call our sweet spot area. And this is where we want to execute our trade. So we can see here that we are buying at discounted prices. So if we see here that when we enter on our OTE, price doesn't go back down, and you can use a very small stop loss if you have other kinds of confirmations. So this tool on its own can be traded by itself. You can use this tool to take trades based on discount or premium, depending on what you believe the market flow could be, but you need to establish other confirmations with this tool to make best use of it. So you can trade it by itself or use other confirmations to also give you additional confluence, order blocks, fair value gaps, RPLs, and anything in the future that I will show as different concepts. So we can see here that price came from this zone, rallied up, and came back down. So the banks and the institutions sold so that they could buy at a premium price. And that is where the large move came into play. And we can say this again. So this was our low, and this was our high over here on these bodies of those candles to the bodies of these candles. Now again, we are in an upward trending direction. So for us, we are looking to buy again. So we place our fibs from the body of this discount level to this area over here where there was a peak formation high. And you can see again that price came into a discounted area for us to add or take a new position based on the flow of the market. And you can see that when we bought at a discount, we would have been taken nicely into the trade over there like that. Now, that's just a bullish example. This video is going to be fairly quick. It's not much to it. It's either buying at a discount or selling at a premium. And the idea is that you use this either on its own or with additional confluence. So let's just take a look at this zone over here. We can see that we have ourselves over here a bearish order block. Okay, so that is a bearish order block over here. And also we have a liquidity void sitting over here. So we can establish that price will want to come back and retrace to close and balance price and possibly test this order block. Now also we have our institutional price level over here of 500. So now we are just going to show ourselves we have additional confluence to enter a trade to take a sell here. So now we can take our fibs tool and place it on the bodies of this peak formation high over here to the bodies of where price started to retrace from. So we can see that this was the peak high of the bodies, not the wicks. Forget the wicks, we only use the bodies. And this was where price bodies started to retrace from. So when price retraced up to close this liquidity void, we can see that we also have a bearish order block. Now, as an additional confirmation, we also have our IPL level over here, and we can see that we had a retracement into our 79%, our OTE, and our 62% level right here. So now if we were to enter a trade at, say, the OTE, we can see how tight of a stop loss we can use just by using multiple levels of confirmation here. So just by looking at this trade, we have an order block, we have a liquidity void, and we have an IPL, and we now are using our fibs. So not only do we have those other tools, we now have an additional tool to add to our arsenal, and this is our fibs tool. So that IPL, the order block, the liquidity void, and our fibs gives us 4 confirmations to take a sell to this position. And if we had entered at, say, our OTE, we could have used a very tight stop loss, say, just above the 50% level over here of this order block, which would have been about 25 pips. And to the downside, the peak low was about 118 pips. So you can see there, that was an ideal trade setup. So these kinds of trades do appear on a daily time frame, weekly time frame, 4 hours, 1 hour. You can basically use any time frame to frame up an entry using your fibs. There's no time frame limit, whatever works best for you. And these setups, you would want to use your fibs as an additional confirmation. So we can see that if we take a look at recent price action over here, that if we wanted to place our fibs on somewhere here, so this is a 4-hour chart, let's go down to the 1-hour chart over here and see if we can find ourselves an entry based on the fibs. So if we look here, when price came to this level over here and fell, so this peak high formation over here down to this low over here, we can see that there's an order block over here on this 1-hour time frame. So we can take from that order block and put our fibs on that level just like that. Because why am I putting it there now? Well, let's just put this aside. So if we look here, based on this 1-hour time frame here, we have ourselves a bearish 1-hour order block. So I'm just going to put that in pink color. So here is our bearish 1-hour order block. So we know that when price came here, there was an order block that was responsible for taking this move to the downside. Now, not only that, we also had a fair value gap over here that had not been filled. So this was another additional confirmation to us that this could have been a great sell setup. So now we have a 1-hour order block. We have ourselves a fair value gap over here. And if we look, there's probably an institutional price level here. Yes, there is. So our 200 institutional price level. So now I take my fibs, I place the top of the fibs because it is bearish, and I pull it down to the bodies of these candles, and we can see that now I have an additional confirmation to add for the reason for me to take a sell in this area. So this is a 79% retracement, and you can see it's just wicks in this area. So if we had taken, say, 50% of the liquidity void, or sorry, the fair value gap in this scenario, and also institutional price level, as well as the bearish order block we have here, we could have been taken into a very decent trade that would have taken us a rather large swing down. So this is something to keep in mind, and basically we can just repeat this scenario over and over again. So we can see here that here is a bearish order block over here on the 1 hour time frame, and when price came up, they wanted to sell at a premium price, so they bought price up and they sold at a premium. Now we can also see that if we look very close, there was a fair value gap over here, a 1 hour order block, and if we see also a institutional price level of 500. So there was actually, again, multiple confirmations to us that we should have taken a sell at this position over here. And again, we can see that here is an order block in this area. So here is a bearish order block, and this was the peak low of the bodies of that move. And if we look, do we have an institutional price level here? Yes, we have an institutional price level of 200 right here. So there's also a fair value gap, but that fair value gap did not get filled in this particular scenario. But we could have had that as an additional confirmation. So there we can see price retracing into our optimal trade entry before our 79, touching our 62, and again taking us into the trade for a downside move. And that one would have given us 75 pips. So you can see generally when we are taking trades with this additional confirmation, we have very tight stops. Now generally retail traders trade with anything 40 to 50 to even 80 plus pip stop loss on most of their trades. So trading institutional allows us to get very tight stops, and generally you want to start at say a 50 pip stop loss to get started and work your way down the ladder so that you can identify good trades, and the tighter the stop loss, the bigger the risk reward ratio. So eventually you can work yourself down to say a 15 pip or a 10 pip stop loss, and you'll see your risk reward ratio go through the roof, and you'll start making some good profits because you won't be stuck on such small lot sizes. The stop losses will be nice and tight and giving you good entries. So we can see if we look at some other examples over here, if we take our fibs in this scenario and we look for say a peak high over here. So here was a peak high to a peak low, and remember we take from the bodies, and we can also see that obviously this is an order block and a fair value gap that needed to be filled. So that fair value gap needed to be filled, as well as this order block over here, and we can mark that one up as red, and we can see that order block is basically responsible for this big move to the downside over here, and this fair value gap was closed. And where did price retrace into? Basically you can see the candle bodies are closing at the discount price. So remember, price fell and retraced, so they obviously want to sell at a premium price. So they bought price back up, and when I say they, I mean the institutions. And when they bought price back up into premium, they sold it down. And you can see that on the fibs, there is also target levels. Now, generally, these target levels are applicable to the time frame that you are using. So the amount of pips will vary depending on the time frame, but generally you want to take profits or close some of your entries, maybe leave some running, but generally this is the area of where you want to start looking to take some profits off the table. You can see here that this area here was target 2, and price did not go too far below this area before it retraced back up. So these three levels of the fibs, the profit scaling, the first profit, target 1 and target 2 are generally good areas to take some profit off the table based on the time frame that you are using. And obviously we always want to be in profit, so taking some and leaving some to run is always a good idea. And so yeah, that was bearish and bullish scenarios and discount versus premium. Basically the same thing, banks buying and then selling at premium and selling and buying at discount. So you can re-watch the video, and basically that's all that there is to the fibs. So one more thing I need to show you, and if we have users that follow our institutional order flow strategy, so if we follow institutional order flow from the bullish order blocks that were created here, we can clearly see that price is going up from order block to order block. So here is our next order block over here, and price rallied from this order block. And this order block here, this last order block before this peak formation high, was broken. And when this order block was broken, this becomes our breaker, as you know, following our institutional order flow. So when we have our breaker, we can also use our fibs in this scenario. So again, this is for the application using institutional order flow. So you can either use what I've showed you first, based on discount versus premium, using the bodies to the bodies, or you can use the source. So this here is the top of the source, so the wick. We use the wick in this scenario. So this is the wick of the source, and then we use the candle that created the breaker. So this scenario here is the candle that created the breaker, and we use the wick of this candle. So we pull our fibs bearish because we have our breaker. So we pull our fibs from the wick of the source to the wick of the candle that created the breaker, and we can see price retrace into our source and also into our sweet spot area of 79 OTE and 62. So this can also be used as an additional confirmation of where price can potentially come to when you are following the institutional order flow. And again, we can also see over here in this area here that there was also a fair value gap sitting here, another reason to take that particular trade. So now not only are we following the institutional order flow, we have our source created, we have our breaker created, we are now just waiting for the retest. So when price came in, closed this fair value gap, we are also selling at a premium price. And you can see there that that was also a good move. Now, you don't need to follow the institutional order flow if you are not following that particular strategy and you are just trading other concepts. But we could have also just taken the bodies of this candle to the body of that top of this candle, and we would have had a similar result. But this is not always the case. This particular example here shows us that we got a retest, but that is not always the case. And sometimes using the source wick to the candle that created the breakers wick will give us OTE, whereas using the bodies to the body will not always give us a sweet spot entry. So that's something to keep in mind, that using the sources wick to the bottom of the candle that created the breakers wick is good to use if you are following the institutional order flow. So if you're not wanting to follow the institutional order flow, that's fine too. And you just want to trade order blocks or fair value gaps using institutional price levels and using your fibs as an additional confirmation tool, that's fine too. But obviously everything I've shown you can be put together into one large strategy. You can form your own strategy. Each concept is so powerful enough that you can create your own strategy. These strategies or concepts that I show you are very applicable to any type of trading. So you can do this on currencies, on Bitcoin, you can use it on indices, gold, pretty much everything. And the same would apply. So as an example, here is a gold chart over here. And let's just look at the 1 hour chart over here on gold. And if we can see that when price recently traded to this high over here on those bodies to the low of these bodies, and if we pull our bearish fibs from those bodies to these bodies, we will see that we would have got an entry on our sweet spot over here. So again, we have on this 1 hour chart, we have a bearish 1 hour order block over here, and possibly if we go down to a lower time frame, it's likely that there would possibly be fair value gaps at some point to be closed. Okay, in this particular example, there wasn't a fair value gap. There was one, but it didn't get closed. But we can see that price wicked, or not wicked, basically came on the 1 hour chart. Or yeah, there was a wick on this 1 hour chart into our sweet spot, and then for the ride down. So let's just see if we can find some other examples of a bullish setup over here. So again, if we take the low of this candle from these bodies to the high of these bodies over here, and we pull a fibs, now we don't always get a perfect OTE entry, but we can see that here again, there was OTE on this particular example. So optimal trade entry again in our sweet spot zone right over here. And sometimes we don't, and you will see maybe just a 62% bounce in a very bullish scenario. But here we did get a bounce off this level. And if we look, this is also a fair value gap over here on gold. So also a order block at the bottom here. So again, we have additional confirmation. So here is our bullish order block on this 1 hour time frame. And we can see that price rallied from this order block, creating this fair value gap. We pulled our fibs from the bottom of this red line where the bodies are to the bodies of where price rallied to. And when price retraced, they retraced back down. So rally up for the buy and retrace down into discount price and left off from right there. So this, you can see an additional confirmation. We have an order block, we have fair value, and now we have also discount price. So let's just see if we can find a bearish example on this. And when price rallied from a high, we might get one here from these lows to these lows. We see that we do get a bounce off that area. So yeah, these highs over here. So those highs right there from that order block basically to the bodies of this over here. Just like that. And so price sold off, we know it's bearish. And when price rallied and retraced, the institutions wanted to sell at a premium price. So this is what we see here, price coming into our sweet spot zone, not only that, they also filled up the 50%, all about 50%, maybe a bit less, of this liquidity void on gold. So we can see price rallying, closing some of this gap over here and selling at a premium. So gold likes to give us lots of pips. So if we had entered somewhere around here, let's say the 62%, there we go, 300 pips. So that was a good example of a sell. And let's just have a look at another example here. Let's take a look if we can find ourselves a bullish example. So if we take our fibs from here to here, on this level over here, we can see that that is a rally up, and we can see that this fair value gap was closed on gold, and also when price retraced down, we can see that we had 79% retracement and then a move up from discount level. So rally up, retrace back down into our 79%, and we can also see that that is an order block and also filled some of this fair value gap over here. So again, multiple confirmations, and then price is bought at a discount price. Rallied up, and there you go, 800 pips, just like that, all for 1 hour chart. So we can see this happen multiple times. I've shown you what I've needed to show you, and if you have questions, well, we have a chat, and the best is to go and practice it. So yeah, hope you find some use for what I've showed you here, and happy trading.